On this episode of the Eisman Playbook.
I would not be incrementally adding to positions right now. I think that the group is, positioned to be at best a market performer. And I know that if we get a deal with China, the market's going to go bananas and everything's going to move up. But my sense would be that the dynamics of the new home market are not going to get better. In fact, they could get worse. If we start to see what I think is going to happen, and at least in my little ecosystem, we're already seeing managements are starting to have staff reductions. And you're seeing a pullback in CapEx spending.
Hi, I'm Steve Eisman, and welcome to my podcast, The Eisman Playbook. In my 35 years of experience of investing in markets, I've seen many ups and downs. You might know me because I was depicted in the book The Big Short by Michael Lewis and portrayed by Steve Carell in the movie of the same name. In this podcast, we are going to explore and analyze market trends, companies, and subsectors with various guests in and around the financial world. My goal here is simple: to educate. So come and join me as I share with you the Eisman Playbook. Hi, this is Steve Eisman, and this is another episode of the Eisman Playbook. And today we have a very special guest and a good friend, Ivy Zelman, who is the housing analyst at Zelman Associates, a boutique firm. Ivy and I go way back, probably to as early as 2005. So welcome today, Ivy Zelman. Get ready, Ivy. Here it comes.
All right.
So we go way back. We probably started talking around 2004 and 5 when you were at Credit Suisse as a bank analyst. Not a bank analyst, housing analyst. That is your area of expertise, and that's what we're going to talk a lot about today. And when I was thinking about how I was going to introduce Ivy, I decided I divide the sell-side research world really into two different types of analysts. There's the most common version, which is an analyst who is knowledgeable, but is very scared to anger the managements of any of the companies that he or she covers because they're petrified of being cut off from information flow from those companies. And they like to take managements around to visit investors. And I call this version of the sell side the concierge version of sell side analytics. You're like a concierge. Nobody really uses you to pick stocks. They use you for information. And then there are the very few analysts who do their own research and are not afraid to piss people off. Ivy, you're in my Hall of Fame, of which, believe me, there are very, very, very few members. In the 90s, when I was a sell-side analyst, I pissed people off, but I didn't know any better. So when you were doing this, you knew better and you did it anyway. So let's talk housing, and let's do it this way. We'll reminisce later. We got a lot to reminisce about. But what I want to talk about first is, if you go back pre-crisis, what were the companies? Forget about that they all blew up. We all know that they blew up and it was a disaster. I'm more interested in how were they run and how did they change? So that if you were going to compare, let's say, a Lennar or a Pulte or a DHI in 2005 versus how they are run today. Walk me through that transition.
Well, first, thank you for the introduction. Very kind and appreciate it. And great to be on your podcast. I'm excited.
Thank you. Yes.
For having me. I think the most obvious answer would be the difference between today's balance sheets versus pre-crisis. They were fairly levered companies with debt to capital ratios that were in the 50-60% range. And they also held a lot of land. Although they were optioning, they still owned several years of land. Whereas today, their debt to capital ratios are in the teens or even negative net debt for a few. So very, very low leverage now. They're also hands, maybe not necessarily 100%, but many of them have really gone to almost a complete option model, using land bankers and purchasing land through options from farmers. And
let me just pause you for this. So you're saying that back then, they would literally just go out and buy the land, cash down.
They were buying land with cash or financing it. And they also at that time claimed they weren't taking entitlement risk. So they were still, feeling that they were being prudent. But the amount of parcels that they acquired were very large parcels. For example, I remember Pulte in '04 took on a tract of dirt that was like for 3,000 to 4,000 units. And today, they're more likely to do a few hundred units at a time and have phases where they're taking down 50 plus.
And so could you but just explain how when a home builder buys land via option, just walk us through the process of how that is done today?
Depending on who they're actually contracting with, for a land banker, they're typically putting down a deposit anywhere from 10 to 15% for the right to exercise the option down the road. And they're going to basically decide, okay, this is a good opportunity for me to use land now. We're ready to roll. So they acquire the land when they're ready to break ground and go vertical. As compared to historically, they would hold the asset and it would sit on the balance sheet, and you'd have very low returns because of that. It was tying up so much capital. Their inventory turns were very low, which are still not very favorable in my opinion, but it was still a better risk model, risk-oriented or less risk-oriented model than it was back then.
Okay, so it's a less levered model. Is there anything else that they do that's different today?
When I started covering the industry, dating myself over 30 years ago, I was told that in the growth periods, they would be generating negative cash flow, and in downturns, they were cash cows. And so that was sort of the strategy, just continue to drive growth through utilizing all of cash and leveraging up. And then today, they're generating cash flow throughout growth and the downturns or softness in the market. So they're still cash flow positive throughout whatever the backdrop is, which I think is a definite improvement and better managing their overall working capital. They're doing a better job than they had been.
So would you say that the people who run the companies are just more professional?
I think they're more professional today. I think that managements that were part of the GFC that are still in place have done a lot more to professionalize their operations. And then there's other companies that have new managements that came in, maybe from even different industries, that have done a good job to put them in a position to have much better overall performance. And most of that is really focusing on returns. In fact, it's going to make you laugh, but I remember being at a conference we were hosting when I was at Zelman Brothers, which dates pre-Credit Suisse.
Please don't tell that. So long ago, we don't want to talk about it.
Anyway, I was at Zelman Brothers. I was hosting a conference, and I remember Stuart Miller and Bruce Gross, who was at the time the CFO, coming up to me, and they were
of which company? Of which company is it?
Of Lennar.
This is Lennar. Okay.
And they were. This is back in, call it, the mid '90s. And Stuart was, why don't you pick up our stock? Because I was ramping up. I only launched coverage really in '93. So at this point, what I try to do is start covering all the home builders, but I hadn't launched on them yet. And I focused with them and the conversation. I'm like, well, your returns on equity are really lousy. And they were like, what, returns? What are you talking about? They didn't even look at that.
They didn't know what that was.
They didn't know what that was.
Okay, so these guys they were home builder junkies.
Yeah, it's like Bob Toll of Toll
Right.
Brothers, who is no longer with us, and I adored him. He was really funny. Lots of good Bob stories. But one of them, when we were talking about the land that's on the balance sheet, that's raw land, as opposed to finished lots that have much more costs that are already been incurred. He's like, listen, don't tell me my land isn't worth anything. I'm a home builder. We buy land. That's what we do. And this is in the face of the crisis when they were writing down land. And so he couldn't believe that analysts were giving a hard time and saying that land values are going to be under pressure. So it was just the lack of education on what investors really cared about was very clear and evident in the pre-GFC management teams.
Okay, so before we turn to new homes and the home builders, let's just talk briefly about existing home sales. To put it bluntly, they suck now. So I wish there was a better way to put it, but it's worse than that. It feels like the entire market is just, what's the right word I'm looking for? Stuck. It's stuck. So, stuck. I mean, for listeners who are not as familiar with these issues as you and I, why don't you just tell people, why does the existing home market just suck so bad?
Well, we go back to the 5 years when we entered into the pandemic, and we had clearly, a lot of fear of unemployment surging, and everybody pulled back, the developers pulled back. But what really became obvious was the Fed was going to do whatever they needed to help the economy from slipping into a severe recession. So by lowering rates, we got to a point where rates were so low that you can actually purchase a home for less than a 30-year 3% fixed mortgage. So the market went nuts, and turnover was accelerating, really driven by very, very high velocity. And fast forward 5 years later, that policy by the Fed to basically stimulate the economy through lower rates has been now the backlash is that we have more than 75% of homeowners that are locked in below 5%, and close to half of them that are locked in below 4%. So they don't want to.
What percentage are like at 3%, would you say?
It's probably in the threes. I'd say it's probably about a third, but definitely enough to keep people saying, I don't want to give up this low rate. So that's been the case for the last several years. And as a result of that, inventories have been very, very depressed, but yet home prices have continued to move higher as a nation, and more so depending on what market you're in.
And why do you think that is?
Because there's just not enough supply. I can give you an example. When I bought my house in Cleveland, the house that I bought was on the market for 7 days. And if I didn't pounce and buy that house, and I would definitely miss it. So whatever is in a good location, it's maybe well priced or fairly priced, it's going to get multiple bids in markets where inventory is really, really tight. And that's still the case. So for example, in 2024, home prices in Cleveland, where there's not a production home building presence of any significance, the migration that happened during COVID, everybody went south to the Sun Belt, the demand, though still much more primary demand in Cleveland, home prices were up 8% in Cleveland in 2024. And compare that to markets that are in South Florida or Texas markets, actually prices are negative. They're down in certain submarkets like Austin, Tampa.
And why do you think those markets are down recently?
Because there's too much supply.
Too much supply.
And there's too much
building.
supply, and I think that the market's been normalizing. But when you're looking at the divergence we're seeing in home price performance, it's really about inventory.
Okay.
And so nationally, existing home sales, we believe, are going to start showing growth off a very depressed base. But that's because inventory in the United States is finally moving higher. So we're looking at growth year over year in inventories that are listed, new and existing, about 20% higher than a year ago. And in some markets, it's actually above where it was pre-COVID. And because there's more inventory now, people have more choices, and therefore there's more competitive pressure. Builders have been offering significant incentives to provide value to first-time buyers as well as move-up buyers. And now that there's more inventory in the market, there's a lot more pressure for sellers that basically might have been sitting there and there was no alternative. Now they have alternatives. Now they can sell their house and go buy a new home that might be a really good value and giving them more incentive.
So let me press that for a second. So if you go back, let's say 2 years, correct me if I'm wrong, as I recall, I was kind of surprised that the home builders were doing so well because the existing home market was, as we said, sucked, and mortgage rates were much higher. But the only game in town was a new home, and the public home builders, and we'll talk a minute about how much better the public home builders have done than the private home builders, but they were buying down people's rates. So if mortgage rates were, let's say, 6.5%, and you went to buy a new home at Lennar, maybe they gave you a 5% rate or a 5.5% rate, and that gave you enough room to be able to buy the house. So the home builders, the public home builders, had a period where they were doing really, really well. And then that seems to have ended. And my question to you is, why has that ended?
Keep in mind, in 22, when rates first started moving up, there was a period where there was, very little demand. And despite the builders starting to dip their toe into the idea of buying forward commitments to buy mortgage rates down, it was probably a 2-quarter lull that they didn't really have very good sales, even though they were starting to buy mortgage rate down. Now, people were scared. Home prices, they thought, were going to be under pressure, and no one wants to be the dumb guy who buys at the top. So when people started stepping back in and home prices were stable to even moving higher, that buy down strategy really worked for them. And when you think about for the last, call it 3 years, that they've been utilizing buy downs, they've absorbed a lot of whatever pent up demand, I believe, would have been prevalent during the post COVID period where a lot of people didn't get to buy. They missed out. And while affordability is really stretched, if your builder's offering you a pretty good incentive, and some of them are even buying down rates into the fours, they might be at a 3.99 for the first year and then goes to 4.99 the second year, and the third year they'll go to 5.25 for the next 30 years, for the rest
Okay.
of the duration of the loan. But now one of the consequences of that activity is that today, even when rates come down a little bit, nothing from that buyer's perspective has really changed. They're still getting that below market prevailing rate. So they're still getting a good rate from the builders. So I don't know if they've just absorbed enough of the pent up demand, and therefore we're kind of in 5 years later. We've had tremendous demand during COVID. So I think they've kind of started to see demand plateau in the face of so much uncertainty. And what's happening with the existing market
But
is
this
now
was happening even before this year. You were seeing, like I said, there was a period where every single home builder was just doing great. The conference calls were like rah 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 rah,
right.
and then maybe starting maybe almost a year ago, or maybe a little less, that seemed to have ended. I don't understand. It's almost like they just sopped up the excess demand that ended.
Keep in mind that the spec levels that are in the market today are pretty elevated. The number of units that have been started that have yet to be sold, they're not as high as they were during 2006 when they peaked at close to 300,000, but they're in the total specs on the ground today are over 100,000 that are already completed, and then you add the ones that have already been started, you're probably closer to like 250 or something. So there's a lot.
250,000 spec homes in the country.
If you're including the ones that have been started and the ones that have been completed. We worry more about the completed ones. But in any case, because there's a lot more spec inventory, which has been a strategy of many of the management teams to provide move-in ready product for people that were, sitting on the sidelines waiting and didn't want to wait. So that was a strategy that enabled them to really gain share from the existing market because there was no inventory. But today, as I mentioned, the hottest markets, called Sunbelt markets, they now have a lot more people listing their home for sale. So there's now competition that makes it more difficult for them to move that spec inventory because now there's choices for consumers and maybe even better deals. And the builders, it's interesting, the median price for the new home builders is actually on par now with existing home prices. So I think that's the first time we've seen that. Historically, new home prices were trading at a premium to existing anywhere from 10 to 25% in places like California. So now they're really on par, which you'd think would give them even more demand for their product because there's a better value equation. So they're still selling. It's not terrible, but they have no pricing power. They're utilizing significant incentives. Their margins have come down quite a bit from their peak levels. So they don't have as much cushion now continuing to offer mortgage rate buydowns, which are very expensive. And we do have so much uncertainty that buyers in general are sort of taking a wait and see approach and feeling not very confident in the outlook of the economy because of what the new administration's been up to.
So let's talk investments. Just stick with the home builders for a second. In a paragraph or 4 sentences, what do you think of the group as stocks right now? Forget about individual stocks, just as a group as a general matter.
I would not be incrementally adding to positions right now. I think that the group is, positioned to be at best a market performer. And I know that if we get a deal with China, the market's going to go bananas and everything's going to move up. But my sense would be that the dynamics of the new home market are not going to get better. In fact, they could get worse.
Because?
Well, first of all, we have had pretty strong job growth and everyone's been surprised on the resiliency, especially with all the federal layoffs, most recent job report. If we start to see what I think is going to happen, and at least in my little ecosystem, we're already seeing managements are starting to have staff reductions, and you're seeing a pullback in CapEx spending, and all of those factors eventually will show up with, I think, less employment growth, which is the most important thing next to confidence for consumers. So if we have good job growth right now, and the market's already challenging because affordability is so stretched, what's going to happen if job growth weakens and consumer confidence remains stressed? I think the builders are going to move that inventory, whatever they have to do. So it's really going to be, as one industry executive, we quote this industry executive in our report we published today, our preliminary home building survey that showed that seasonally what month are we in? The month of
May.
April. The month of April,
Your April survey.
we just did the April survey. It was a preliminary survey. We're down nearly double what we would typically see from March to April. So from a seasonality perspective, April was much worse than normal, and that's with massive incentives. On our incentive scale, 0 to 100, we ask our 20% of the builders we're surveying as a percent of the new home market, how much incentives are you using? Where would you rate incentives? And right now, it's pretty much at the highest level we've seen, at 85 on that scale of 0 to 100.
Wow.
Some markets have been more significant. So I feel like there's no rush to own them. People look at the value trap and say, well, they're really trading, their PEs are really low, their price to book multiples are also very low. And, if you have a long-term horizon beyond a year, which we typically are measured by a year, maybe a 5-year time horizon, you can buy some of the small cap builders that are trading well below book value.
So let me press that point for a second. So the PEs of this group have always been low. And I think probably even more than PE, people have always traded this on a price to book value basis.
Right.
And as you have said many, many times, when they get to, and you'll give me a number in a second, when they get to X, hold your nose and just buy it, because they're not going out of business and it'll recover, and that's when you make the most money. So first of all, what's X?
Okay. So I learned early on as an analyst starting out in this industry, you buy them at book or below book and you sell them at 2 times book. That was sort of the parameters, and you couldn't get a portfolio manager to even look at these things typically unless they were book or lower. And there was a lot of pressure when they got to that higher end of the range. And I think the big question mark is that the right valuation measure that is basically the best way to value the companies. And there's been a lot of debate about them being re-rated higher because of the improvement that we talked about earlier, the balance sheet.
So let me press that point, because the argument that I heard from a lot of people, which, first of all, when a group is valued a certain way for a very, very long time, it takes a long time to move the group to a different valuation, no matter how compelling the argument is. I don't care what sector you're talking about. But the argument that people have made about the home builders is that, pre-crisis, they bought land themselves. They were very, very levered. And today they're better run. They option. The balance sheets are much better. So the argument goes, they really shouldn't be valued on a price to book, or not nearly as much, and the PE should be higher. That's the argument. And that worked for a while until the fundamentals got worse and people went back to price to book like they always do. But I'm curious what you think, just in theory, about this argument.
Well, to your point, I don't think that a sector that has been traditionally, always sort of in the doghouse with respect to how they're valued are going to be able to get re-rated successfully without proving that in the next downturn they're going to perform better. As much as the management teams are telling us that they're, going to have higher troughs than they have previously, they're not going to have the type of losses they've experienced previously, they're very much still cyclical businesses. And so when you look at the performance and how well they've done, even pre-COVID, think about all of the benefits from home prices surging that we had, not surging pre-COVID, but during COVID, and the incremental value that they were able to drive to gross margin because of the pricing power they had. If you take away pricing power and you take away low-cost land, which they acquired pre-COVID and basically rode that, low-value land and had phenomenal margins as a result of it, what happens if we don't have low-cost land anymore? Because now they're buying market land values as opposed to during COVID, they were much cheaper. So I think the question for us is, what's really changed about the fundamentals of the business to reduce the risk in a downturn? And when you take away the pricing power and a low cost basis for land, it's really hard to get, it's really hard for me to be convinced that it's really different this time when I look at measures like inventory turns, which are still pretty low as an industry. There's a few outliers. So where have returns really, the 20+% returns that they now are generating that they're claiming, therefore we should have a higher rating because we have sustainable higher returns. If you're not generating, if you don't generate pricing power, if you don't have pricing power and you don't have that low cost basis, when demand weakens, where are returns going to go? And we think they could still probably go to single digits. We're already seeing that right now. There are some of these operators that are already generating just this most recent first quarter earnings, like Beazer, their returns are in the high single digits. So I don't feel comfortable.
And things are not that bad.
And things are not that bad, but the deterioration in their, P&L metrics, along with, declining ROEs in a good economy still, from my perspective, if you don't have pricing power, you now have to buy land at retail. It's kind of hard to believe that gross margins are not going to be doing anything but going south. And again, they've already morally normalized. So where do they go from here? They could go lower, and then we have to be concerned about what it means for potential impairments.
Okay. So all right, we beat the group to death. Let me ask you a social question.
Okay.
Affordability for most Americans to buy a home is poor. Can you put some numbers around that? And then let's talk about why.
So really for affordability, there's three inputs: your wages, how fast your wages are growing, the mortgage rate you have, and then the value of the house, right? The home price. So those three inputs determine how affordable a product is. And today, affordability for the existing market is about 20% above historic trend line. And
I'm sorry, say that again.
So from an affordability perspective, because existing home sales only, the 85% of the market today, the home builders are about 15% in terms of share. The existing home market, when you look at your monthly payment as a percent of your gross income, is about 20% above what it's been historically. So
it's more expensive.
Correct. It's
Okay.
The affordability is very stretched, and that's definitely not the case everywhere, but in most markets, it could be much higher than that. Then in some of the markets, it might be a little bit lower, but everybody's a little bit higher or significantly higher than historical levels.
And so if we think of it a different way, like what percentage of working people can't afford to buy a home? It must be very high.
That can afford or can't afford?
Cannot afford.
Cannot. Correct. Yeah. Cannot. I mean, we look at the burden when you think about how many renters today are spending more than 30% of their income on their rental unit. And that number is north of 50%. So when you think about, if I'm spending more than 50%, call it 50, 55% of my income on my rental unit,
you can't afford to buy a house.
How am I ever going to save? How am I ever going to get to a down payment?
Right.
Am I going to ever have enough?
So let me ask you a question. Why? We're not talking to stock analysts here. We're talking as human beings. Why is it that the United States of America has a housing affordability problem? Like, why? Why can't we make home? Forget about manufactured housing, which has its own world to it, but you still got to buy a manufactured home in a spot. Why is it that we make homes that are basically too expensive for most Americans? Why?
Well, first, I think it really comes down to the cost of lots. And when you think about the inflation we've seen in home prices, it's really fueled by inflation in land. And if you go back for the last, post GFC, land values really haven't gone down. They've continued to go up kind of 10% per annum on a trend line basis. It was way above that during COVID. And so if anything, when you look at the lots that builders can go vertical on, they can't get a return if they're going to price homes, at what would be arguably an affordable price. That's one aspect of it. Another concern that we have that the builders have definitely pointed out is that a lot of municipalities will not let them go lower in square footage, and there's restrictions on minimums. So I just found this out in September when at my housing summit, I was on a boat hanging out with a bunch of builders, and I was like, you guys just need to build smaller square footage, and I know you're doing that. He's like, look, we have a lot of communities. We can't go below 1,600 square feet.
And for a house.
For a house. They want to go.
The zoning will not allow you to do that.
In some communities, that's the case. So there's zoning rules that mitigate their ability to build smaller, more affordable homes. And there's also the NIMBYism that's everywhere in this country, that people don't want those communities that are affordable communities near where they live. And because they're the voters, for our lawmakers are usually pushing back on trying to increase affordable housing. And lastly, and there's other issues, when you think about the builder who's buying this, let's say, inflated lot, and they are trying to get a return that justifies the risk, they also have what's called impact fees that are pushed to developers by the municipalities. And what that means, if you're going to build a new community, let's say in your Florida markets, somebody's got to figure out where are the new services that are going to be required in that community. You're a pioneer, you're going out to a third ring of an employment center, and you want to build affordable homes. Well, who's going to pay for the schools? Who's going to pay for the fire department, the
So they
police,
slap a fee on you.
And the fees are just exuberant in many
So let me
markets.
ask you a different question. Let's say President Trump called you tomorrow and said, Ivy, I want to make you my housing czar. Okay. And let's say you said yes. Okay. We don't need to go into whether you like President Trump, you don't like President Trump. President called. He says, Ivy, you're the most knowledgeable person out there on housing. I'm making you housing czar. Do you think a federal housing czar could even do anything that would improve the situation?
Well, I've talked about this a lot with, the management teams of the public home builders as well as some private builders. And I think an easy one that would help, we'll start with the easy one, is if you look at the affordable mortgage financing, it's really FHA, VA, where people can put down for VA, they can basically have no money down, and those loans perform despite 100% loan to value. VA loans perform very well. The FHA, which is really for first-time home buyers that haven't bought a home in 3 years, they only have to put down 3%. And their back-end ratios are more relaxed. So it's like the American dream. Get someone in home ownership. That's a really only form of wealth creation. And over time, that home price will appreciate. So getting them into a home is important for them to have, for their families, create wealth. However, if you go into certain parts of the country, the FHA, the FHA ceiling that is allowed is determined by an entire MSA. So
what is MSA?
Metropolitan Statistical Area.
Okay.
So if you take, for example, the Inland Empire,
which is in California.
In California, it's a massive metropolitan statistical area. They have the loan amount that FHA can lend up to is the same amount for the entire MSA. So people that live in Corona, which is closer to LA, they can't buy with FHA because it's above the FHA limit.
I see.
But why is Corona priced with an FHA limit that's the same as what's out in Victorville? So which
is lower.
Correct.
Okay.
So just recognizing that's an easy fix, in my opinion, to try to have more granular ways to show the FHA ceilings and limits. Bigger than that, and as many builders have I spoken with, the real question is, how do you get the local markets to work with the federal government? Because they basically control what gets developed and what doesn't.
Like these impact fees that you mentioned.
Correct. And one way the federal government can try to influence those decisions is by withholding funding, like they're doing with universities today. Now, you can argue that's not a good strategy. I don't know what else, other than tax incentives to the local jurisdictions or threatening funds will not be allocated to them unless they provide this much affordable housing. And knowing this president, he might be willing to do that.
Okay. Maybe he'll call you. All right, let's do a little reminiscing in some of the time we have left. So I was a sell-side analyst in the 90s. You were, but I was never at a bulge bracket firm. I was at Oppenheimer. You were at Zelman Brothers, and then you were Credit Suisse. So I don't think everybody who listens to this podcast even understands the pressures that a sell-side analyst at a bulge bracket firm, forget about, housing and making a call. Just speak generally from your experience. What were the institutional pressures on you just on a day-to-day basis in terms of, catering to investment bankers, catering to investors? Give me the push me, pull you that faced you that you were facing all the time. Well, I was too stupid to care back in the 90s. I just didn't care. That was my crazy personality. But then again, I was not at a bulge bracket firm, so I didn't have the same institutional pressure you have. But I think it'd be interesting for people to understand what that was like for you or for anyone.
I remember early on when I was, I think it was at Solly, but I was definitely, dealing with pushback from investment bankers that didn't like the ratings on some of the stocks that I were covering. And I didn't even understand it. That, what do you mean? You need to, these are clients of ours. We need you to be more positive. And I was like, can't do that. And that didn't go over too well when I pushed back. And I got to be known as someone who was not someone who was easy to work with.
I got this. You were not easy to work with.
No, I was not easy to work with. And I think
how did that impact you at the firms that you were at?
I think the good news is that both at Solomon and later, more importantly, at Credit Suisse, I did have support from my research directors that, didn't require me to change my ratings. And, there'd be some discussions above my head, but there was no question that with really good research directors, you get protected. But, during the pre-crisis, when I was bearish, I had so much pushback. I mean, it was awful. I mean, I spent nights at home, which you probably don't even know, crying on my couch because, I was wrong. Stocks were going up in my face every day. Institutional investors that are at big places like Fidelity would call and complain about my questions on the conference calls because I was asking about loan to values and FICO scores and things that I was concerned about. And so I'd have salespeople complain to
By
my
the way, the things just so everybody knows, the loan to value ratio, people know, is the loan to value ratio. So if you take out, let's say you buy a house for $500,000 and you took out a loan of $500,000, the loan to value ratio is 100%. That's not good.
Right.
And a FICO score is a credit score. So a good credit score, let's see, would be 750. A bad FICO score would be 600. So just to make it simple, if you found out that let's say Lennar was selling a whole bunch of homes at 100% loan to value ratio to people who had a 600 FICO score, that's bad.
Right.
And guess what? A lot of that was happening.
Right. So I had complaints from clients. They didn't like what I was writing. They didn't like what I was saying on the conference calls. I had management teams that were complaining about me, talking behind my back, making fun of me for being wrong, calling me jihad behind my back.
They called you jihad.
They called me jihad. I can't say
lovely.
Exactly who, but I know that they were. And they were making fun of me. Oh, someday she'll be right. I remember Jeff Metzger at KB was laughing behind my back. But I do think that where it really got tough, and I can handle the management teams not liking me, I can handle clients not liking me, but my own sales force turned on me. And I think that was really tough. So I fortunately had a few people like you and others, as well as my industry contacts were private companies that were helping me stay grounded in my bearish views.
By the way, I used to treat you like my shrink because I remember there was a period, and I'm trying to remember, I think it was like in the spring of 07. And it was this crazy environment where subprime paper was getting worse. And
well, New Century filed in March of 07.
What was the year where the home builders rallied hard in the spring? I think it was 07.
07. It was great. We loved it. It was great because
it was going up like crazy. And I was short all these stocks, and I was like, I think I'd call it, Ivy, what the hell is going on?
Right. And I think a lot of that I attribute back to my buddy Bob Toll. And it's a funny story because back when they reported their fourth quarter.
This is the CEO and founder of Toll Brothers.
Correct. And they were on their fourth quarter conference call in 06.
So that's probably late January?
Well, no, because they're not a fiscal December year end.
February?
No, their fiscal year end is in October. So they were reporting in November.
Okay, so this is November 06.
Right. And at that time, the stocks were down probably 40, 50%, because during the spring of 06, it became pretty obvious that not only had inventory increased substantially and they were seeing pressure on sales, but they were also seeing investors fleeing, which was one of our big concerns, that there were so many investors in the market. So I'll tell you Bob Toll's story, then you'll laugh at another story I got for you. So Bob Toll, I'm on the conference call and I'm dying. And they, by the way, my colleagues that I worked with, like, you remember Dennis and Alan, they're like, let's not let her on the conference call anymore, because if I ask a question, there's going to be a fight. Because I just couldn't help myself. I couldn't stand it.
I'm sorry, who was saying this to you?
My colleagues, my partners.
Your partners, your research analyst partners.
Yes, my research analysts.
They were telling you to shut up.
Or they just told me to calm down. Because I got in fights on conference.
Be nice. I remember the fights. I used to enjoy them.
Yeah. And I think when Bob Toll talked about DC is getting better, this is on their fourth quarter conference call, I got on and I said, what Kool-Aid are you drinking? And I was like, what? And then I hosted
He must have loved that.
Well, this followed my housing summit, which we do every September. And they were calling that period the Zelman bottom, that it was the bottom in the stocks. And they just took off. The stocks doubled from where they were. Yeah. And we published a report in December of 06 called 10 Reasons to Sell Home Building Stocks. And I wrote it in 5 minutes. I was so pissed. And
so you were inspired.
I was pissed. Yes, I was doubling down on my call. But another funny story was in February 06 or February 07. February '07. I was at a industry event in Aspen, and I was on stage, and I'm presenting. We had published in '05. No, maybe this had to be '06, and we published in '05. This was the year that they got smoked. They went from '05 to '06 is when they summer of '05 to '06, the fall. That's when they got cut in half. But I was on stage and I was actually showing slides from, remember, Investors Gone Wild. That was a report we did in July '05 to talk about the significant presence of investors, and we were going through mortgage data, and I was telling this to the audience.
So you were talking about there was a whole new group of people who were buying home that were just purely speculative investors to buy
And
houses.
I was showing, charts to show what percent are investors, what percent are Alt A, which is not call it not a traditional buyer, not to bog down too many details, but everyone in the audience was not happy. These are all builders. Everyone in the room is like, probably sitting there wanting to shoot me. But I mentioned specifically Jerry Starkey and WCI being the main culprit of selling high-rise condos to investors. And when I got off the stage and everybody's kind of standing up, all of a sudden Jerry Starkey was running towards me like a linebacker, the CEO of WCI. And I put my hand out and I go, "Stop right there. I'm not going to let you speak to me because I see you're not okay." It was really bad. It was really bad. And I had a few people holding him back. But anyway.
I remember around that time, I think my brother-in-law was getting married. And so it was Key Biscayne was the wedding. We flew down to Miami. We got into a taxi. It was taking us over the bridge to Key Biscayne. And when you're driving on that bridge, if you look to the left, you could see Miami Beach straight down. And there were cranes in Miami Beach back then, literally like on every block.
I remember.
And I turned to my wife and I said, "Look to your left. Take a look at that." And she goes, "What is that?" And I go, "That is Armageddon. They just don't know it."
Absolutely. I know we had a place in Northwest Florida, and I was at the gym in this community, and the guy that's a trainer, he's like, "Oh, I just bought a few lots." The guy in the beach that put umbrellas out for everyone, he was just buying some lots. It was like Investors Gone Wild. It was totally nuts during that period. And whether it was cranes or, every Tom, Dick, and Harry were buying homes, and they were doing it, to your point earlier, with no money down. And the mortgage market was bananas.
So let's end with maybe some advice for young people.
Okay.
If you were talking to even one of your kids or a friend of your kids who wants to go to Wall Street and has an analytical bent, what would you advise them?
Assuming they wanted to be a sell-side analyst or even a buy-side analyst, which means they're actually managing money, my recommendation is to not rely on public management teams for the insights about the business, about their business, and about the industry, and to find private companies that operate in that industry, find vendors that supply the public companies, and work to develop your own thesis utilizing those types of resources that are not public companies, basically. That's
basically what do your own work.
Yeah. And know that, I was a beneficiary of an incredibly fragmented market. When I started covering the builders, their market share was less than 10%. So there was so many private builders that I was able to meet and befriend and exchange information, that I was able to develop surveys around that strategy that really were, monthly. They are monthly, and they get in front of what the publics are going to say. So we've made some really good calls because that correlation between the private companies and the public companies is over 95%. So it's kind of like almost too easy in some of our areas. However, their market share now is 56%.
Up from 10.
From 10, 30 years later. And I would say that we're still able to still survey 20% of the market because we have attrition, companies get acquired, but we get new builders, but it's nowhere near as easy because the fragmentation is not what it was.
Got it. Ivy, thank you. It's always a pleasure.
Oh, it's awesome. I'm so excited. Thanks for having me.
So our podcast has gotten a really nice reception. I've received a ton of positive comments, and we've gotten a lot of questions. So we're going to introduce a new segment, Steve's Mailbag. I'm going to try and answer as many questions as I can. Here are a few. So number one, Market Strategy at Jones D3V asks, "I'm new to the market and investing as a whole, and I've lost a good sum of money trying out strategies I found in online tutorials. I would sincerely appreciate any recommendations you have. So I don't have a response to you right now, market strategy, but I am going to do a financial literacy masterclass in a few weeks. And hopefully a lot of your questions will get addressed in that master podcast. So stay tuned. Number 2, Adrian Chance on Spotify has a question, which is, if Trump persists with his tariff policies, which companies and governments would be at greatest risk in the event of a U.S. bond market collapse? And then there's another similar question from @Yelp2. What if China dumps its U.S. treasuries? So my answer is, I think one thing that most people don't understand about the global financial system is that it lives and breathes and functions on treasuries. So for example, banks lend to each other all over the world overnight through a market called repos, which is in the trillions, and it's all done on U.S. treasuries. You have major funds like sovereign wealth funds who park their money in U.S. treasuries. There is really no alternative to U.S. treasuries. And until there is, this is really not a problem I worry too much about. Number 3, @Slitherben asked for another comic book recommendation. @Slitherben liked my prior comic book recommendation so much, they want more. So if you're interested in superhero comics, I would try Avengers Disassembled and its sequel, The House of M. And for those of you with a more serious literary bent, I would read Lucifer, which is a spin-off from Sandman. And finally, @VKF asked, since the point of tariffs and ensuing trade war is in order to bring manufacturing and jobs back to the United States, what's a reasonable timeline for when manufacturing will be planned, executed, and opened, and has it even started? Well, the answer is that, yes, it's already started. It actually started post-COVID. Companies learned that the global financial trading system was far more brittle, and the supply chain was more brittle than they had thought. And so they started to bring back at least some of the supply chain back to the United States. So some factories have been built. President Trump is trying to dramatically accelerate that process. But generally, it takes 2 to 3 years to build a state-of-the-art factory from planning to completion. Thanks for listening, and please send in more comments and questions. And be sure to listen next week to our next episode of the Eisman Playbook, and be sure to catch our weekly wrap-up that we post after the market closes every Friday. See you soon. Thank you so much for tuning in. For video episodes of this podcast, head over to our YouTube channel. If you're listening on a podcast platform, make sure to follow the show so you never miss a new episode. And if you got something out of today's conversation, we'd love for you to leave us a 5-star review. It helps us reach more listeners just like you. For links to our website, social media, and to sign up for our newsletter, please check out the show notes of today's episode. On that note, I'm Steve Eisman. I'll see you on our next episode. A quick disclaimer, nothing on this podcast should be considered an investment or investment advice. Guests and their hosts may have positions in any of the stocks mentioned in this podcast. Please do your own work and consult an investment advisor. This podcast is produced by Collier Landry for Don't Touch My Radio and Steve Cohn for Next Horizon Media. Copyright Stephen Eisman, Farseer LLC.